Okay. Hello. Sorry. Okay, I'll repeat. Welcome to today's webinar. This is Caroline. Today I'll be having a short recap of a report issued last week. The counter is Hobby Land Limited. On 7th of March, Hobby Land has announced its acquisition of the second London office property, 1 St Martin Le Grand, for a price of £171 million. This property is located in the western core of the London city and is only about 200 meters for the London Stock Exchange. Thus, it enjoys popular demand from the financial houses. For now, it is 100% leased to 5 tenants with an average lease of that will expire in 8 to 12 year times. What is our stand on Hobby acquisition? We feel that this is a positive move for Hobby considering the current weak sentiment of the local luxury residential market. So what we feel that since now the current passing rent is about 20% lower than the surroundings, we feel that there will be significant rental reversion in 5 year times to 2019 when 50% of the lease will be due for renewal. In the near term, Hobby's strategy is to solidify its recurring rental income stream and to also overseas portfolio diversification for enhanced return. We estimated 70% of the acquisition will be actually financed by borrowing, and even though after the acquisition, Hobby net gearing ratio still remain low at 0.32. For that, we maintain our rating at accumulate with a target price of 2.55. Thanks. Now I'll pass over to my colleague, Colin.
Hi, thanks, Caroline. Next, I'll be doing a quick recap on the Singapore telco sector, on our earnings and our outlook, and follow after that will be a US counter that will be covered by my colleague, Yong Kai. Okay, for the Singapore telecom sector, just a quick update on the results. For the last quarter, Singtel and M1 report a gain year-on-year in the net profits, and StarHub's 4Q13 profits, however, is down 5% year-on-year, but that's mainly due to a deferred tax that's in 4Q 2012. So hence for the quarter they actually incur a higher taxation year-on-year. For the full year, however, M1 and StarHub's profits were up 9% and 3% year-on-year respectively, and for Singtel the 9-month period profit was up about 4%. Okay, on the Singapore market, first on the mobile, across the telcos, they're reporting higher revenue, and that's coming from data monetizing as more customers are exceeding their data allowances, and also from this year, all the three telcos have increased their data access charges per gig, and also revenue is also increasing due to increasing subscriber base. For the pay TV segment, both StarHub and Singtel have reported a net addition to their subscriber base, and for the last quarter, StarHub's pay TV revenue up 2% year-on-year, and this was after several quarters of declining revenue as StarHub actually starts to gain from the BPL cross carry. In the broadband space, M1 continues to gain from a low base, and however Singtel and StarHub's revenue are declining as there's intensive price competition that's still ongoing, and the competitive pressure is coming from the smaller fiber players such as MyRepublic and ViewQuest. Overall, on the 2013 performance, across the telcos, the margins, we see an improvement in margins from about 28% to 31% for Singtel and M1, and across the three, they're reporting a stable earnings growth that's ranging from 3 to 9%, with M1 being the biggest gainer. Okay, the improvement in margins for Singtel was mainly due to effective cost management in the Optus business, and for StarHub and M1, the improvement margin was mainly due to low handset sales, and there's less cost of sales being incurred as usually handsets will come to subsidies. So we are seeing an improvement in gearing for both M1 and StarHub, and that will imply this better dividend prospect ahead. So all three are the telco counters are offering a very attractive dividend yields of more than 4%, with StarHub being the highest. That's very close to 5% based on current pricing. Okay. Recent development updates. Optus chief, Mr. Kevin Russell, has announced that he'll be resigning and he'll be leaving on end March 2014. So in the interim, Mr. Paul O'Sullivan, who's the CEO for Group Consumer Singtel, will be taking over. So and also on the pay TV space, Singtel actually has secured exclusive rights to a World Cup 2014 event, and they're actually offering free for new signups or recontract on their TV platform as a measure to lock in the subscribers. Otherwise, subscribers will have to pay a one-time $105. This fee is excluding GST in order to view the World Cup matches. Although we still this may have a slight impact on StarHub's gaining back market share in the pay TV space going forward, but we don't see that this will be a very significant impact on the business, as mobile will still be the key driver to earnings growth for StarHub. And also the World Cup matches will still be available on StarHub's platform via cross-carry. So on the outlook of on this sector, M1 continues to be our preferred pick, and we are positive on the telcos monetizing mobile data, and this is going to be the key driver to drive earnings growth ahead. We have downgraded Singtel to neutral on the 14th Feb. That's mainly based on our concerns over Optus business outlook, as Optus revenue has been declining and they have been losing mobile subscriber base to the main competitor Telstra in Australia. So our target price for Singtel is about $3.53. For StarHub and M1, we are maintaining accumulate ratings, and based on the target price and current prices, that will imply about at least about 9% capital upside. Okay, so now I'll hand over to my colleague Yong Kai to speak on outer wall.
Hi, this is Yong Kai, the US Equities Analyst. So today I'll be presenting on Outer Wall. Okay, it's a company listed on Nasdaq, and it trades at less than 7 times forward free cash flow. Just a quick snapshot. $64.70 share price, which is somewhere around middle of the 52-week range. Market cap is $1.4 billion, and price over forward free cash flow is 6.9 times. So it owns two segments. One is Coinstar. 1989, this founder had the idea of installing coin counting machines. Okay, so now it's found in 20,600 locations, primarily across US, and generated $69 million operating income on $300 million annual revenue. So they can either opt for upfront cash, which they get charged a 10.8% service fee, or gift card, which charges no fees. So this gift card comes from retailers such as iTunes, Starbucks, and Amazon.com. So I mean, upfront the consumers are charged no fees, but these retailers will pay a fee to Coinstar. Okay, so having this 10.8% service fee actually pushes these consumers towards opting for the no fee gift cards. Next, we have a Readbox. So in 2002, McDonald's actually pioneered this DVD rental kiosk to increase traffic. Outerwall bought this venture for about total of $200 million between 2005 and 2009. So today it's found in 36,400 locations in US and Canada, and just last year alone it generated $239 million operating income. Okay, so this last year alone generated more operating income than what it paid for the full venture between 2005 and 2009. Each kiosk features up to 200 titles and 700 DVDs of movies and video games. So right now it has 50% market share of physical rentals. The rest is held by the physical stores such as like Video Easy kind or your DVD by mail by Netflix. So they have surpassed the 3 billionth disc milestone rental in July 2013. Why we like it? Why we like this company? Because Coinstar, it overwhelmingly dominates a mature market, which is coin counting, and it's also a cash cow with a very simple business model. Alright. For Redbox, it has grown at high double digits since inception 10 years ago. As recently as 2012, it was actually featured as 100 fastest growing companies. And right now, it continues to gain market share from physical stores, such as when Blockbuster liquidated in 2013, and Netflix DVD by mail. New Ventures, which ascribe zero value, develops new self-service concepts. It generated $26 million operating loss, so it's actually obscuring and penalizing financials of the more established Coinstar Redbox. Last year, since 2011, it spent $800 million on share repurchases since 2011. Alright, so if you look at the market cap, right now it's $1.4 billion. It actually spent more than 50% of the market cap buying back shares in the last 3 years. Lastly, we have activist hedge fund, Jana Partners, which has an 8.4% stake and pushing for changes. They accumulated this somewhere around last October. So we could just show you how we arrive at the valuation. We sum up Coinstar Redbox as well as the liabilities, corporate debt, and unallocated overheads. So we apply a 10% holding company discount, which arrive at a fair value of $95, which is 46% higher than today's market price. And we have a trading buy rating on it. If you want more information, you can actually find it from the report issued last week. So I'll go into more details now on the investment rates. Coinstar, okay, how it works, The thing is that most US banks don't provide coin counting services. Instead, the consumers have to sort out hundreds of coins counted by hand, then roll them up in the coin rolling paper provided by the bank before you can deposit it. Okay, for the banks that do have coin counting kiosks, after you deposit the coins, you still have to go and take a receipt and go and queue for a teller to cash in. So anyone who has been to a bank before, you know that queuing for a teller is really quite painful. Furthermore, non-account holders are charged between 3 to 8% for using this service. The alternative is that you can just go to any of the 20,900 Coinstar kiosks, you dump the coins, and you can opt for no-fee gift cards almost instantaneously. Okay, and this from retailers such as INTU, Starbucks, and Amazon.com. Okay, Coinstar has a very big wide coverage, nationwide coverage. There's 20,600 locations, whereas your nearest competitor, TD Bank, has only 900 locations. Even Wells Fargo, even if they install Wells Fargo is a bank with the biggest number of branches in US. Even if they install a coin counting kiosk in every single branch, there are only 6,000 plus branches, which is still less than 1/3 of Coinstar's coverage. So in all, Coinstar, this coin counting machine, dominates mature niche market with a simple business model. The ongoing capex is very low. As you can see in most years, the total growth and maintenance capex actually adds up to less than depreciation and amortization. And there's also very cheap to maintain. For every $3,000 plus of operating income it earns, it only costs about average of $450 to maintain. Okay, for this year, its depreciation and amortization is projected to exceed total capex by $18 million. Okay, so this actually understates its earning power. We think it's a mature cash cow. Why? Because overall, there's a 3% annual growth in average transaction size. In 2010, it was about $38 per transaction. In 2013, it was $41 already, and this year is projected to increase further. So we actually expect it to generate $62 million after tax free cash flow on a standalone segment basis. This will translate into roughly 20% free cash flow yield. Could be worth 12 times multiple given its resilient nature and high margins, and that it still continues to grow year over year. So this will valuate at roughly $35 per share. For Redbox, 68% of the US population lives within 5 minutes drive of the DVD rental kiosk, which is present in 35,900 locations. So they can, Redbox is actually mostly they found in strip malls, grocery stores. 40% of these Redbox kiosks are tied up with Walgreens, Walmart, as well as Kroger, these grocery stores. So after they're done with their grocery shopping, they can either physically browse through 200 titles at Redbox, or beforehand, they can just go online, check on the title's availability, and then you reserve it. DVD is only dispensed after the consumer swipes his debit or credit card. okay, you might know that in Singapore there is also DVD kiosks, but they are like almost dying. Okay, they lack traction locally. Why? Because renters are charged one-off $3 to $5, and then they lack the incentive to return quickly. If you ask around, this DVD local operators will tell you that it's very hard to chase them for returns, and then end up that they just own the DVDs for $3 to $5 one-off fee. Okay, and also that means that there's very low turnover. You don't want to go to a DVD kiosk in Singapore and find that, hey, actually 70% of these titles are rented out, and that you need to know when are they going to return it. Whereas in contrast, the DVD red box costs $1.20 rental per night, and because you swipe your credit cards, you are continuously billed until the DVD is returns, and you can return it to any red box location. So there is this network effect. Every minute, right, 1,500 DVDs are rented from Redbox. Okay, so 1,500 DVDs are being rented out from Redbox every minute. And still furthermore, right, it's underutilized. You're looking at average of 48 rentals per day per kiosk. You compare that to 200 titles and 700 DVDs. So there's still plenty of organic growth. And management has already said that they are not going to grow the kiosk very aggressively. So right now they're just looking for organic through customer relationship management, and they don't have to spend any more on growth capex. So, okay, I mean, you might be concerned the DVD market is shrinking. Yes, we are not disillusioned. We agree that, okay, so we look at the charts. From 2009 to 2013, the DVD Blu-ray sales of top 100 titles actually shrunk from $4.5 billion to roughly $3 billion. The Netflix DVD by male members have also decreased by 66% from 2010 peak as well. At the same time, you look at the red bar, Redbox revenue increased by 155%. Okay, they increased by 155% in 4 years to $2 billion. Why? Because they've been taking market share and they continue to take it. Now they already have 50% market share of physical DVD rentals, and they continue to thrive at the expense of Netflix DVD by mail because it's not instantaneous. And your brick and mortar, you're looking at stores like Blockbuster that used to have 3,000 stores, and they are the biggest chain, but yet they had to file for bankruptcy in 2010 and complete liquidation last year. Why? Because there's so much overheads, rentals, labor, when you talk about physical stores, whereas a Redbox rental kiosk is just a kiosk, 12 square feet. How much do you have to pay for it? And then you do have to pay for labor as well. Everything is all automated. So we think this is the trend going forward. The DVD market continues to shrink, but Redbox can continue to gain market share and at least maintain a stable revenue. We think that you've reached an inflection point of growth. So you look at 2010. In fact, even the years before that, growth capex has been higher than your depreciation and amortization for many years. But they deliberately cut back on growth capex in 2013 when they felt that they have really saturated the kiosk markets. And there's no need to add any more because you are gaining market share naturally, and you can do it through organic growth. So now your EBITDA, your depreciation and amortization is so much higher than your total capex right now. And company has cut back on it to make it for cash flow. So you look at the green bar. In 2010, it's almost negligible. $20 million after tax free cash flow. But in 2013, it's increased 10 times to $240 million. And in 2014, it should be increasing even higher to $290 million. Okay, your revenue has grown as well very rapidly, but they increased the price by 20% in 2011, and this wasn't repeated thereafter. And Redbox has also physically saturated the kiosk market. Bear in mind that Redbox is the only DVD rental kiosk around. The other competitors are all minor. You are looking at anything less than 100 DVD rental kiosks. So at 9 times multiple, we think that it could be worth $123. Okay, because of the amount of free cash flow that's being generated. Since Redbox is, if you remember, price today is around $65. So this price is actually roughly 2 times of the share price. So we spend a bit more time talking about the competition. So we have iTunes rental. Okay, iTunes rental you can download it immediately. Why do you go to a Redbox? The thing is that for iTunes you are paying $4 to $5, and then for the moment you watch it, you have a 24-hour window to finish, and then you just disappear from the iTunes library. Whereas the average consumer spends only $2.50 every box, and this implies a 2 nights rental. If you want to be very, I mean, you can always spend only 1 night, rent it for 1 night only, and then you spend only $1.20, and that's still cheaper than iTunes. Furthermore, US internet download speed, right, is 60% slower than Singapore. So things that we take for granted, streaming, is actually not as practical in US itself. And bear in mind that this is average, so there's a lot of places that have way below average internet speeds. Online streaming, Netflix Netflix, if you remember, is actually one of the best performing stocks last year. Okay, they cost $8 per month, and then they have a very huge content library that allows you unlimited streaming. So Netflix really targets the heavy users that watches many hours per month, whereas Redbox is ad hoc movie viewing. The thing is that Netflix might have raised prices because they agreed to pay more to Comcast for more bandwidth, i.e. faster speeds. Okay, why? Netflix is actually a prime target for internet carriers because if you look at the red box that I highlighted, they account for 32% of peak data traffic. So you are competing with, okay, 1 out of 3 users are competing with each other to stream from Netflix. And really, a lot of Netflix users are complaining about poor streaming experience, about pixelation, about slow speeds. Okay, so this is something you have to really bear in mind. Okay, again, bear in mind, just remember that when we talk about US internet download speeds, it's 22 megabits per second. Netflix, right, if you're a Netflix user, even the fastest Google Fiber is you're getting about 3.8 megabits per second. Okay, so Google Fiber is actually state of the art. Yeah, they're just newly laying it, and then they're only starting in a few cities to test it out. This state of the art latest technology can only provide you a speed that's 83% slower than the national average. Okay, because there's so many people all streaming from Netflix at the same time. So I would say that Netflix is really a victim of its own success, and if it increases speed, you push more marginal users over the red box. Lastly, okay, so all in all, we have been talking about bandwidth and speed at the same time, right? But you have a broadband data cap as well. Okay, these are the trends. Once Comcast and Time Warner merges, then you're going to have the cap in place. Australia already has it. At 30 gigabyte, you're paying $55 per month. Okay, compared to 2.8 gigabyte per hour to stream a HD movie. What this means is that at 30 gigabytes per month, you only have enough data to stream about 10 hours of movie. Either that, or you can just go to Redbox and rent a Blu-ray DVD for $1.50 per night. So we think that as there's more data caps in place, such as those on mobile phone plans, you're going to have more people, you're going to have more people either subscribing to unlimited data or switching over to Redbox. And we think that there's still some viable place. Okay, a few more points. Aggressive share repurchase. They actually repurchased 20% shares in 2011 to 2013. And then just this year, 1 week ago, they completed another modified Dutch action tender offer for another $370 million shares. So that's roughly around 20% of its outstanding shares again. It's a really very brilliant decision because right now it's trading at around more than 14% free cash flow yield, but its borrowing cost of its term loan is only 1.81%. Lastly, you have this Jana Partners, which is an activist hedge fund. They accumulated an 8.4% stake and push for changes. They have a very good track record. They successfully sold Safeway to Albertsons for 30% profit. So that's why we have a lower holding company discount as well. Of course, the new ventures will have zero value. We think that it might be conservatively worth zero. Personally, if they turn profitable, or if you shut down, you cut losses and your tax benefits, then you accrue to the company. So two of these notable ones, one is Redbox Instant. They own 35% of it. They partner with Verizon to stream online. The next one is 100% of Eco ATM. So they recycled more than 2 million phones in 4 years. Basically, this is just a reseller. You go there, you sell your iPhone, you sell your Android, and then they'll pay you cash upfront without all the haggling, without with a lot of transparency. Okay, and these are ventures that we ascribe zero value for now. So some of the past valuation, we factor in the net debt. After it's completed its repurchase, so net debt will have increased to around $44 per share. And we also capitalize the uneducated corporate overheads because it's not possible to just terminate it. Okay, you have to reflect it, the ongoing relationship. So we are looking at around $9 liability per share. So again, this is how we derive it. Coinstar $5, Redbox $123, New Ventures 0, and then you have $44 corporate debt and $9 of unrealized overheads. You apply a 10% holding company discount to this subtotal, and you get $95, which is 46% higher than today's market price. So finally, just some ending remarks. Management guided to $200 to $240 million free cash flow this year. This is defined by operating cash flow minus capex. If we actually use the lowest end of this free cash flow, $200 million, we'll still arrive at a very attractive 6.9 times multiple right now. And this multiple, and this free cash flow, right, $200 million, is already depressed by the new ventures, which requires around $30 to $40 million growth capex. Okay, so this actually subtracts away from Coinstar, from Redbox, the healthier financial performance. we think that it could be easily worth $104, which is 60% upside, if we apply a 10 times multiple to a $200 million mid-range guidance, but opted for the more mathematical and lower sum of the parts valuation. So in conclusion, Coinstar and Redbox. Coinstar is a coin counting machine. Redbox is a DVD rental kiosk. They generate a lot of free cash flow and effectively monopolize the coin counting and DVD rental kiosk markets. There's $800 million of share repurchase, which is more than 50% of today's market cap. You have an activist hedge fund, a general partners lobbying for change, and you're getting all this for less than 7 times multiple. We think this is very undemanding and there is substantial upside today. With that, we're going to open the floor to Q&A. Thanks.
Hello, it's Joshua here, the head of research. Are there any questions for the team today? Okay, there's a question here that a reminder the client is looking at the US market, how to retrieve back the archive research in terms of slides and recorded voice. Yep. So this is on www.uniphilip.com. Okay, so if you go there, you can find our slides and the webinar archived, and you can look back. The reports are also found on Poems. What's the outlook for the STI and Dow Jones? Our near-term outlook is that things are looking short-term bearish. So Kenneth has guided, I think sometime in January and February, that in the near term we are probably likely to head lower or consolidate sideways. However, we do not believe that this bull market is over. We believe that we are in a long consolidation period, and we could possibly start to head higher again in the second half of the year or next year.
Hi, so we have a question. Do Coinstar and Redbox give out annual dividends? Okay, no they don't, which I'm actually quite pleased with. Why? Because they are actually buying back their shares at a 14% yield. Okay, so they are reducing the number of outstanding shares rapidly, and this increases the shareholder returns. Next is that dividends for Singaporeans, they are actually subjected to a 30% withholding tax rate. So I'd rather they channel 100% of their cash flow back to buying back shares than us receiving only 70% of what they're giving out in dividends. Okay, but that being said, they are constantly reviewing their capital allocation decisions. So in the future, they might give out dividends, just that as of right now, they feel that share repurchases at 14% free cash flow yield is a much more brilliant decision. Thanks.
Right, question on the direction of the HSI. Okay, so Hong Kong and China. Okay, last year we were overweight both on cheap valuations, but at the end of last year and the beginning of this year, if you notice, we actually downgraded China, we downgraded Hong Kong. Despite cheap valuations, we decided to take the risk and just downgrade both to neutral to underweight. Okay, so basically, yes, they are cheap, but there are just so many macro headwinds that are facing China at the moment. Right. As you know, there's a lot of imbalances in the real estate market, in the shadow banking market, the imbalance between manufacturing and services. And although services are expanding and are taking up more share of the economy, manufacturing is shrinking, and basically this represents overall GDP drag. Now, the other thing is that like China is heavily the Chinese index is heavily weighted towards banks, financials, and basic materials. You know, all three indices, all three sectors of which are facing challenging headwinds, right? So that's why we are actually neutral to underweight the HSI, the HSCEI, the A-share index, acknowledging that although it's cheap, we may not be heading higher anytime soon. China will have to work, China and Hong Kong basically will have to work through all these excesses. Thanks.
So we have another question. What happened to outer wall in September that took a dive? Okay, so in September, right, they give their guidance for the first half of 2013. The things that in first half of 2013 you have Summer Olympics that took away some of the demands for entertainment as well as the weaker box office. So that's why in September you saw the share price underperforming, but subsequently the hedge fund came in, and also in the third quarter and fourth quarter you have positive same-store sales. So both led to the share price rebounds very drastically. Thanks.
Hi, question on the Nikkei. Yeah, the Nikkei is also not performing up to expectations. So one of the reasons is that on the structural reform side, things are still pending. And in the meantime, there is a consumption tax that is coming to broaden the tax base of Japan. And so that adds some uncertainty because people don't really know whether the consumption tax is going to affect GDP growth or not. Okay, we have some questions here on DBS, whether it's still the preferred choice. Yes, it's still the preferred choice of the banks. Although you will notice that a while back we actually replaced DBS from the top pick list to Silver Lake, right? Because DBS is quite widely exposed to China, so to be on the top pick list, we can't have too many possible headwinds to the stock, so we removed it, and we actually put Silver Lake on instead. What's our view of the acquisition? Okay. Hi, there's a question on DBS acquiring SocGen. Okay, we will give a more in-depth analysis of this when our banking analyst returns from leave. Okay, there's a question here. It's quite difficult to recommend Singapore stocks at the moment because this presentation is mainly US. Actually, we are devoting about 20% of our coverage to the US because basically that's the trading flow at Philips Securities, right? About 20% comes from the US counters. So we are stepping it up. So that's why it feels as if we are doing more US these days. However, for Singapore stocks on our recommendation list, we have had Balsted, which has done very well, and First Resources, which has also done very well. Silver Lake is a bit flat at the moment, but we think that towards the second half of the year, perhaps it might strengthen as well.
Hi, there's a question on Ezion Holdings. Fundamentally, Ezion is still a very good stock. We are still having Ezion as our top pick for offshore marine sector, given the fact that 30 SEU contracts that are contracted, there are only 17 of them that are contributing at the moment. 17 other SEU units are going to start contributing over the next 2 years, so we still see EPS upside over the next 2 years with an annual CAGR of 30%. So our rating for Ezion remains at accumulate with a target price of 253.
Okay, thank you for your questions, and we would. Oh, there's a question here on Sembmarine. Hold on.
There's a question on Sembcorp Marine. Our recommendation for Sembcorp Marine remains at neutral, given the fact that there are still near-term headwinds for this company itself. Its first cruise ship has yet to be executed over at its new Brazilian yacht. So we see this as a downside to its margins going forward. They should be starting the execution of the first cruise ship over at the new Brazilian yacht in the second half of this year. Hence, downward pressure on its margins is expected by us. Our recommendation for Sembcorp Marine remains at neutral with a target price of 420. Thank you. Okay, that's all we have today. Thank you for logging in. Hope to see you all next week. Thank you.